You're tuned in to the Restaurant Rockstars podcast. Powerful ideas to rock your restaurant. Here's your host, Roger Bodwin.
Hi guys, Roger here, and I'm excited for today's podcast. Now I know that not everyone listening is a numbers person. Usually that's the least favorite detail of running restaurants, but it's vitally important to your profits and success. I hope you stay tuned because today I'm speaking with a CPA and tax professional with many years working closely with restaurant and hospitality clients to plan, prepare, and put the books in order for the best possible tax position. We're going to be talking about tax deductions you can take legally whether you own or lease your property, the nuances of asset depreciation and loopholes to speed up the process and take more benefits today than in the future, the best form of organization for your company, taking money out of your company, and so much more. Obviously, this can be complicated stuff. So a strong relationship with an expert in your corner that you can call anytime during the year is in your and your restaurant's best interests. I have a great guest today who's an expert on these matters, so listen closely. I'm sure you'll gain nuggets of wisdom and best practices. Now, on with the podcast. Welcome back, everyone. It's Roger from Restaurant Rockstars. Engaging topics to help restaurants build their brands, rock their profits, and deliver amazing guest experiences. So, I talk often about maximizing profits in different ways in your restaurant through inventory controls and knowing what your prime costs are and all the little things that you can do throughout the year to make as much money as possible. Because after all, this is one of the most challenging of all businesses, and you might as well be making as much money as you can. Am I right? But there's also an important component of preparation at tax time. Never a pleasant time of year on either side, but it's a necessary one. So today I'm really excited to introduce my guest, Mr. Tony Perricelli, and he is a CPA and tax professional from a firm in Carolina called Scott & Company. Tony's been working in the restaurant and hospitality industry for many years, serving many clients in restaurants and hospitality. He also serves as a member of the board of directors of the South Carolina Restaurant and Lodging Association. So welcome, Tony. I'm so excited to have you today.
Thanks. Glad to be here, Roger.
Well, super. So again, we want to dive a little bit into what's important, but why don't we begin, what you just told me a little bit ago was really, really great about how you got into serving clients and now you have a real interest in helping clients in restaurant and hospitality. You've got some success stories on how you were able to, save them some good money. You find things that they miss because let's face it, restaurant owners aren't necessarily on top of their numbers. They're on top of running their restaurants, which is critically important. And that's why they rely on experts. So tell us a little bit about how you started serving restaurant clients.
Okay. Yeah. A few years ago, I was referred a client from a good friend and who is also a client. And he basically was working with this company out of Charleston, South Carolina, to build a restaurant, a group of restaurants that they had developed a concept, kind of a gourmet, fast casual type concept. And so basically, I started working with them and started looking at their prior year tax returns, which had been prepared by other CPAs, and realized that with just a few minutes of research on my part, I was able to find a couple of items on those tax returns, nuances of restaurant type tax and accounting strategies that had been missed by the prior CPAs. And so through that experience of helping these guys out, and basically going back and correcting a couple of mistakes and omissions on their prior year returns, I realized that I had a real interest in serving the restaurant community. And so I drew upon some prior real estate experience as well as just a general curiosity about the restaurant industry and was able to help those guys as well as begin to learn a lot more about the restaurant industry and the tax planning techniques that are specific to that industry. And, there's certain things like the FICA tip credit that every restaurant that has tipped employees should be taking no matter what, and other things related to employment tax credits, because as a restaurant owner, you you certainly go through a lot of employees hiring, and there's turnover, and you want to make sure that you're getting maximum amount of credits that are available in your state and from the IRS as well. So basically, through that experience, I realized, hey, this is a really interesting area. There's a lot of these companies around. In South Carolina, we have a lot of tourism and a lot of, especially on the coast. And so I decided that I would like to kind of dive a little bit deeper into this industry. And from that, I was able to get involved in the South Carolina Restaurant Lodging Association. Joined as an affiliate, as a service provider, started attending meetings, and was able to speak at a couple of the meetings and offer up some educational opportunities for the members, and just get to know a lot of the folks who are involved in the community here in South Carolina. And so it's been a really neat experience. Gotten to know a lot of folks, and I think it's just something that I've really started to enjoy, and look forward to getting more involved in the community.
That's a really, really great story. Now, you mentioned several things that I want to dive a little deeper into, but I have many people in my audience that are starting new restaurants, and they haven't been seasoned operators. So could you explain a little bit more? Obviously, this is a gratuity industry. Restaurants and hotel operations have a lot of tipped employees. They may or may not be familiar what the FICA tip credit is all about. Could you explain that a little bit more?
Sure. The basic concept of the FICA tip credit is that when restaurant employees are tipped, often, of course, you've got cash tips, but you also have credit card tips. Those tips have to be reported for tax purposes. And so the employees typically are responsible for that, but also the company, the restaurant owner, the company is responsible for reporting that as well. And so if you think about how a tip is administered, the customer either gives cash or writes it on the credit card slip, and those funds are basically directed or transferred directly to the employee. And so there's no opportunity for the company, the restaurant owner, to withhold the taxes from those funds. Mm-hmm. But the company is still responsible for paying the Medicare, the payroll tax, Medicare and Social Security tax to the IRS. So right there, you see that the restaurant company, in a way, is responsible for paying taxes that with any other type of employee would have been withheld from their pay. So what the IRS has done is allowed for this credit that says if you have these types of employees and this situation is occurring, you can take a credit to offset that additional tax that you had to pay on behalf of your employee. And it's a very fundamental thing that is done on any restaurant company tax return. You see it most often with full service restaurants, but you can have it sometimes with QSRs or other types of restaurants, fast food type restaurants. Typically, some of the ones like, for instance, Sonic, they have car hops that are tipped, and other types of companies like that. But usually it's for companies that have wait staff that have tipped employees.
Now that brings up another question. Now it's been a couple of years since I've ran restaurants, and this industry is obviously notorious for staff underreporting their tips and not necessarily accurately reporting those. Now the company is on the hook for the full amount of the tips that are earned. Have you seen any issues with that? And is there used to be a rule, I think, years ago that the company had to report on the payroll a minimum, I think, of 15% of all sales that came in through a tipped employee's paycheck. Is that still the case? Has that changed any? What can you offer there?
I'm not positive that that's still a hard and fast rule, but I know there are general guidelines. I've read a little bit of information saying that if there were to be an examination, like an audit done by an agent, they do have certain standards that they look at, and they assume, especially in these days with credit cards being so prevalent, that they really take a look at that and say, okay, if you have a certain number or a certain amount of sales, we're going to assume that there's some minimum percentage of tipping going on related to those sales. And of course, the typical tips are in the range of anywhere from 10 to 20% for most folks. So that's kind of the range they're going to look at. But I don't know that necessarily is an actual regulation that is required. But it's more of a guideline, I believe, that the IRS uses if they're going to to audit you and try to determine if what you've reported is correct.
Yeah, modern POS systems obviously show an employee's sales, and then it also records the amount of tips that an employee will report at the end of the payroll period. And I used to do payroll myself, so I was, really in depth with those numbers. But, most of the time it's like you type in the numbers into the calculator and it would come up far short of 15%. And I think I always used to just edit the tips to make sure it was at least 15. But I knew my people were earning more than 20% on average. We had a really high volume place. So this is really critically important for an operator just to stay on the right side of the IRS and not trigger an audit. So let's talk about asset depreciation, and you also specialize in real estate. So obviously there are many operators out there that own their own properties. They have several locations, that sort of thing. Why don't we talk about what's important there?
Okay, and actually this is an issue that's come up with both two types of companies. Companies that, first of all, own their own real estate, and then secondly, companies that lease, which that pretty much covers everybody, I guess.
Yes.
But so you can have situations in both. So the first type of company, if you own your own real estate, it's very important to understand how that real estate is depreciated for tax purposes. And so when we talk about depreciation, what we're saying there is you have a large asset or something, a capital asset, again, like real estate or equipment or something like that. The tax rules say that in most cases, you cannot just expense the full cost of that asset right away. So even if you write a check, of course, a lot of people don't write checks for real estate. They finance it. But let's say you did. Let's say you wrote a check for $1 million for a building to put your restaurant in. You can't expense that $1 million right away. You have to depreciate that over several years. And for commercial property, that's 39 years in most cases. That's a very long time to take depreciation or to take those expenses. And in a lot of cases, the cash that you have to outlay, even with a 20% down type situation where you're getting a loan and you're getting a 20% down to 80% loan, that's a lot of cash that you're probably not going to be able to deduct in the first year when you actually write the check. So it's very important to understand that there are some ways that you can actually mitigate that to where you can depreciate real estate a little bit quicker than the 39 years. Now, with owning a property, one of those things that we can do is it's called a cost segregation study. Mm-hmm. And I've been involved in several of these over the years. And basically what a cost segregation study does is it takes a look at the property and breaks that property down into its various components. And so, for instance, you might have the electrical system, the HVAC system, the structure of the building itself, the roof, the flooring, the landscaping outside. Okay, and so that's a very important thing to understand just in terms of how a building is put together. And I'm not an engineer or construction guy, but I've gotten to learn a lot about, of course, the components of a building and how they relate to the tax code. And the tax code talks a lot about this. So the reason that's important and the way you can use that to your advantage is because certain components of a building actually qualify to be depreciated much more quickly than that standard 39 years. So, for instance, in the restaurant industry, there's actually a class of property that's 5 years instead of 39. And then there's another class that's 15 years, depending on the type of property and the use. And so I've been involved in several studies, and what these studies do is cost segregation studies is they bring together folks who have engineering backgrounds as well as accounting and tax backgrounds and combine those to break that property down into its various components and be able to accelerate that depreciation tremendously so that maybe you're actually getting, in some cases, your depreciation that you're taking is more than the cash that you're actually spending on the property.
Oh, nice.
That can happen.
Yeah.
Now, one situation that I've actually been involved in, this even in some cases can even be better, is where the several years. And I actually went through this with one of my large franchise clients. They owned about 100 locations of a fast food franchise. And basically, their real estate had been on the books for about 10 to 15 years, or even longer for some of their locations. Some of them were newer. But we took a look at their depreciation they'd been taking, and they had not broken their buildings down into the various components. And so we went through a cost segregation study with them and found out that between the time that they put these properties in service and the current year, which was about 2 years ago, they had missed about $6 million of depreciation over the years. Yeah. All right. Now, that doesn't mean they weren't going to get that at all. It doesn't mean it was missed completely. It just meant that they were taking that more slowly than they could have.
Yeah. It would have been a benefit earlier.
Right. So what we were able to do is, through the cost segregation study, is identify that, but then we made a special election to where they could take that entire $6 million deduction all in 1 year. And so that was a very powerful formula for them, or powerful ability for them to catch up that depreciation that they had not taken. Now, again, I want to reinforce, this is not a out of thin air deduction. It's not something they weren't going to get and then we got it for them. They just were able to accelerate this quicker. It's a timing difference. But when you look at time value of money and just general financial planning, I'd much rather have a $6 million deduction now than a little bit over time over the next several years.
Absolutely. So that sounds like something, the average accountant would have missed, but this is something with you zeroed it in on a clear benefit for this client, and it ended up putting them in a great position. I'm sure they're very pleased with that.
Yeah, they were really happy about that, and we were able to get them caught up. And now, anytime they have a new location put in, we don't necessarily do a full cost segregation study because those are expensive, but we refer back to the ones that we've done and use those as a frame of reference to properly put all their new locations on the books, so that they're being properly depreciated and they're getting the deductions in the current time, or the current amount of time that they should get them. Now, the other side of this I mentioned is a company that's leasing their space, and I had that situation just come up this past year as well, with a restaurant company that did about $1 million upfit to a new location they were opening, and basically we were able to do the same type of a study for that location, and essentially break that down into its various components as well. So it doesn't have to be strictly a company that owns its own property. It can be someone who's leasing space. And if you're putting significant amount of money into the initial upfit for that space, you want to make sure that's also properly classified so that you get your maximum deductions. And so that it can be both ways, be an advantage to both sides.
I want to get into classification in just a minute, but you keep triggering all these thoughts that remind me of past experience. Now, as long as we're talking about depreciating capital assets, in addition to real estate that may be owned by a company, or fit-ups that you put into a lease space, let's talk about equipment and the nuances between those people that buy brand new equipment that has a longer depreciable life versus used equipment that's in good shape, but it's already been depreciated on someone else's books. Like, how does that work out?
Well, the prior use of equipment doesn't really have any impact if you're purchasing it for your business and it's new to you.
Okay.
So you kind of restart the depreciation, now, albeit at a lower price point. Of course, that's one of the reasons for buying used equipment. Of course, you tend to get a better price. Is that based on the
acquisition cost, Tony?
Right, the acquisition cost. There is one element called bonus depreciation, which I don't think we haven't talked about yet, but and actually that's something that's being phased out, so it's not going to be as big of an impact under the current tax rules, but it is there. But that's only allowed on new purchases, so new equipment. So it's not allowed on used. But other than bonus depreciation, which is a big deal, I don't want to gloss over it, but other than that, the normal depreciation basically just depends on what you spend on the fixed asset, on the new equipment, or the used equipment, and you start the depreciation over when it's in service in your company. So that being said, though, there's a couple of items that I think are pretty important to understand about equipment. So the first thing is the IRS has what's called safe harbor rules, And basically what these safe harbor rules say is that if the equipment you're purchasing is under a certain dollar threshold, you don't even have to put it on your books as a fixed asset to depreciate. You can actually just expense the entire thing right away. So let's say you buy a new some kitchen equipment that you need for your restaurant, and if the dollar amount that you're spending is under $2,500, you can just immediately expense it. You don't even have to put that on your books for depreciation. And so that can be a really big advantage, because not only are you immediately expensing that, but also something a lot of folks might not think about is many states, including South Carolina, we have what's called business personal property tax that we pay. And I know a lot of states have that, not everyone, but and typically you file with the state or maybe sometimes the county that you're in, but you're paying a tax on the value of your fixed assets.
Right.
And other than real estate, which is equipment and furniture, things like that. So, of course, you're going to have some of that on the books, but to the extent that you can maybe keep a few items here and there off of your fixed assets rolls, that can actually save you in the property tax realm as well, not just income tax. So that's a good feature. But the IRS rules have changed a little bit in the last couple of years with those safe harbors. And so it used to be that there was no official rules related to that. Then a couple of years ago, they instituted a $500 safe harbor. Now they've revised that rule, and now the new rule is $2,500 for an individual, any individual taxpayers. And so there's also, though, an expanded amount that you can get, and that amount is $5,000. But to qualify for that $5,000 safe harbor, you have to have audited financial statements. And so sometimes that's cost prohibitive for a small company that, audited financial statements, it depends on where you are and what kind of service you're using, but those can be thousands of dollars to get. My company does that. Most CPA firms, will provide that service, but you might spend $10,000, $15,000, $20,000 or more, depending on your size of your company, to get audited financial statements. So in a lot of cases, it's not worth that just to get that additional safe harbor amount. But if it's something you're doing anyways, then it's great to know about, because you can raise that safe harbor limitation. And we found that in a lot of cases, companies that have financing on their equipment or on their real estate or any type of financing in place, maybe even operational loans, the banks are often requiring these audits. So it's something you're going to be doing anyways. So why not take advantage of the additional safe harbor amount, the increased safe harbor amount up to $5,000?
Now that really fascinates me, the whole topic that we just covered. Now that just rings a bell that you really need to develop a really solid relationship with your tax expert, your CPA, and not just wait until tax time to do your taxes. I mean, this is ongoing planning throughout the year. It could be February, you're just buying some new equipment. I mean, you really need to reach out to a professional such as yourself and ask advice. Does it make sense to put this on the balance sheet or put it on the P&L as an expense, and all those types of things? And, in my rudimentary knowledge of accounting, the rule of thumb used to be, anything over, I think, $600 would be capitalized, and anything under that would go on the P&L. And now there's this whole safe harbor rule, and that can be really confusing to an operator that isn't on top of all these nuances. And that's where you come in. You can be of huge benefit just by, offering your advice throughout the year before you even get to tax time. I thought that was a really important point to make.
Yeah, absolutely. And it's important to know that these rules are in place, because like you said, if you're purchasing, say, a new mixer for your kitchen, you're spending $1,000. Well, naturally we say, well, that's a hard asset. That's something that's going to last a long time, hopefully, or a stove or a hood or whatever it is you're buying. But you can't think like that. You have to look at the numbers, and you have to make sure, does this qualify for safe harbor? If it does, it doesn't matter what your instinct is. It doesn't matter what your general thought process is. It qualifies. Now, that being said, I want to make sure everybody's aware that there are different rules for what we call GAAP, generally accepted accounting principles, which is more your general financial statements. In some cases, there could be requirements, say by a bank or other regulatory agency, that you have financial statements that adhere to GAAP, or generally accepted accounting practices. So in those cases, you have to maybe potentially use a different safe harbor amount, depending on what the situation is. So what I've been talking about is strictly for tax planning purposes. So you have to at least be aware of that there could be differences in the way you handle your books for financial purposes or loans or things like that versus the way you handle for taxes. But it is a different mindset that you have to have.
Now, I think awareness is a critical word to use here, because often there are other people involved in the accounting process. So in my case, as an owner, I was, integrally involved in the process for, at least 15 years. I think I did my own books, and then I worked with a CPA professional such as yourself to put myself. So I had a really good understanding while I was doing it. But most operators, they have a bookkeeping firm and they just pass their stuff onto it and they just let it go, and they don't know after that if that person is doing right by them before it is tax time or not. Right. Sometimes there's an office manager involved that just has a very basic bookkeeping experience, and they're just doing the data entry on a day-to-day basis. So when a new piece of equipment comes in, in most cases, maybe they are capitalizing it. They're not aware of these safe harbor rules. Do you find, because obviously this can cost you more money when it's time to do taxes, the condition of your bookkeeping records, when you turn that over to your tax professional, if he's got to do a lot of digging and cleaning up and asking a lot of questions, it's costing more money because, the meter's running, versus if you have a real clean set of books and you have regular communication throughout the year, it just makes the process simpler, smoother, and you're really not likely to miss much.
Yeah, it definitely helps to have clean books, and it's not just the fees that you're going to pay to a tax professional. Obviously, that's one element, but something else that could happen is one example is going back to the fixed assets. When you're purchasing, let's say some of my clients have used equipment brokers to where they're buying a bunch of equipment on one invoice. Okay, and so, or it's all a group of equipment that they're purchasing, and it's being sent on one invoice. Well, if you see that entry being put on, let's say it's $50,000 of equipment, the bookkeepers put that down as a $50,000 fixed asset. Well, you look at that as a tax, on the tax side, I'm looking at the books, I see that, and I think, okay, it's above the safe harbor, so we need to depreciate it, put it as a normal fixed asset. But what could possibly be the case is that $50,000 total is made up of many different items, of which some of those could be potentially under the $2,500 threshold. So you have to look at the individual line items, not just the total on the invoice. So that's one example where bookkeeping can make a big difference. Not just the amount of time that I'm spending to do the tax return, but actually missing something like we just talked about, the safe harbor. So, not listing out each individual item from the invoice could cost you a lot in terms of being able to depreciate that immediately.
Well, that also happens with invoices from suppliers, not just equipment you buy. So you're making a very good point here. And I want to point this out to operators, and it's fairly common if you work with suppliers and you're buying a variety of products, not just food, but you're buying paper goods and you're buying, mops and supplies and all this kind of stuff. In a lot of cases, those invoices are just sort of lumped together where you've got food items in with operating supplies, and all those things really need to be broken out, or else it's going to give you a very inaccurate picture of your food costs. So if you've got a bookkeeper that just says, oh, here's your invoice from, one of the top 3 food suppliers, and it's $5,000 this week, and they classify it all to food, there goes your food costs, and it's not an accurate picture. So, the detail of bookkeeping and understanding all the different items in your chart of accounts and properly classifying everything is really, really important.
Yeah, that is very important from a planning standpoint, like you mentioned, and being able to, and also from an analytic standpoint, just looking at your food costs, your cost of goods sold, and your prime costs, and making sure those are in line. And if something is getting out of line, then maybe you have to dig a little deeper to see what's going on. And sometimes you might find that, like you mentioned, there's additional items on the invoices you weren't expecting. Another area that I think is very important, or a reason that's very important, is because in cases of fraud. It does happen. Anytime you're dealing with a lot of money moving back and forth, a lot of different suppliers. You've got various different groups of folks that you're purchasing your food and your maybe your paper goods and various different things from different suppliers. You've got to be careful because your employees might say, "Hey, I want to order something for myself or order something for personal purposes," and nobody will ever notice it because it's just a few dollars on an invoice, but that can add up over time. I had a situation several years ago with a manufacturing client where one of the general manager was purchasing some items from a normal supplier. It was a regular supplier of the company that they regularly did business with, so it didn't trigger anything there as being an unusual source. But he was purchasing things that he was using on a car that he was fixing up personally, his personal vehicle. But since those items were coming from a regular supplier, the owner of the company didn't pick up on it. Right. And so later on, we went back and found out, well, yes, this is your regular supplier, but these 3 or 4 items, these have nothing to do with your business. These are being stolen basically by your employee. And so that's something to think about in terms of just being aware of what's going on, and your analytics can help with that in terms of percentages and making sure that your food cost and your cost of goods sold amounts are staying within the tolerable ranges and tolerances. And so just be aware that that's something that's could happen, and does happen in some cases.
Absolutely true. Yeah, unfortunately, this business has sort of a reputation for, abuses by staff. I've got plenty of stories over the years until you put systems in place. But working with a professional is just one more check and balance, one more system where you can finally identify some of these areas that you might be losing before. So that's another good point. Let me talk about... Earlier, we were talking about fixed assets and leasing. Now, there are certain deductible expenses if you do a renovation of a property. Can we talk about how much or what you can expense or deduct there from your taxes based on a remodel of a facility when you're first going in? Common area maintenance is another charge that's typically charged by landlords and all that sort of thing, and fit ups when you spend the money. Does it become your asset even though you're leasing a property if you're spending money on someone else's building and it's a permanent attachment, or does that go with the property when you leave? I mean, all these things impact your taxes.
Yes, that's correct. Well, to answer your last question, generally, in most cases, when you're doing an upfit of a property that is leased, that typically reverts back to the owner of the property once the lease term is up. But that being said, you get to depreciate it as long as you're paying for it. You get to depreciate it as the tenant during the time of your lease. Now, as far as general rules in terms of the upfits and remodels, you've got to look at the situation in 2 different ways. First of all, you've got the initial upfit, like I was talking about before, where we did the cost segregation for that company that did the $1 million upfit. In an initial upfit, typically you're going to have a lot of items that are considered fixed assets, depreciated over time. So it's going to be, the construction that's done, the new tile on the floor, the new if there's framing of the interior. If you're starting with an empty interior and you're framing it out, things like that. All of that obviously is going to be depreciated over time. Now, again, we can do the cost segregation and try to maximize the immediate impact and get the shorter lives. So that's fine. Yeah. But the other situation is where you're going into an existing space, either whether you either owned or leased, and you're remodeling it or refreshing it. In this business, every now and then you've got to remodel and refresh your space. It's typically something that needs to be done. And sometimes if you're a franchisee, that's something that's required maybe by your franchisor every few years. So what's happened there in the last couple of years, there's been a couple of changes. And one big change that the IRS has issued a safe harbor for remodel and refresh expenses. And what that, in a nutshell, what that new rule says is if you are doing a remodel or refresh of your space, and there's certain requirements that it has to be interior space and you can't be expanding the building. It has to be within the same footprint of the building and a couple things like that. Basically, the IRS has come up with a compromise that says you can go ahead and immediately deduct 75% of those expenses. And the remaining 25% are just considered under the old rules, the basic rules of depreciation. They're considered a fixed asset. And the reason they did that is because over the years there were many fights between the IRS and restaurant companies, basically saying, well, the restaurant companies, of course, argued that what they were doing was just repairs and that should be immediately expensed. But the IRS said, well, no, these are additions, and you're totally redoing your whole space, and so you need to depreciate over time. Slower depreciation, slower expenses. And so they came up with this compromise that says you can do this and take the 75% as a way to kind of decrease the amount of fighting between the companies and the IRS. Now, the only overall requirement for this is, as we mentioned before, with that $5,000 safe harbor, you have to have audited financial statements to take advantage of it. Right. So this is typically going to be for mostly your larger companies that have an audit requirement. Although, if you're doing several locations at one time, this might be a situation where you'd actually want to go ahead and get an audit done by a CPA firm to take advantage of it, because it could be a big enough number to where it would offset the fee that you would pay. So you have to look at it in case by case basis. But that is available.
Great points. Mm-hmm. Let's talk. I mentioned earlier that members of the audience are starting new restaurants. When I was running restaurants, my properties or my companies were set up as subchapter S corporations, and that was before LLCs were really common. Do you see a benefit, or can you make a recommendation in certain situations where it makes sense to be a sub S corp versus an LLC? I mean, obviously sole proprietorships are dangerous. That's the first thing that they warn you against because of the liability factor of you could lose all your personal assets if you are registered as a sole proprietorship. But what is the best form of organization for, say, the independent restaurant operator?
Yeah, and again, this is a case where you have to say it depends, but in general, in most states, LLCs are a pretty powerful tool. And I'm not an attorney, but I can just kind of speak in general terms that LLC does give you some level of legal protection, of liability protection, at least personally. So that's kind of all I can say there. But I can't give legal advice. But from a tax standpoint, the LLCs are basically have the potential to be taxed in a number of different ways. There's a default setting depending on the number of owners of an LLC, but that can be changed with elections. First of all, what makes the most sense for my company in my state where I'm doing business? In the state of South Carolina, we do a lot of LLCs. There's a lot of attorneys I've talked to that say it might be different. You might want to set up a corporation or something, something like that. So, but that being said, once you've got your entity set up based on your legal advice, then you decide, okay, now how do I want to be taxed? And from an LLC standpoint, you can actually elect with the IRS to be taxed any way you want. You can elect to be taxed as a partnership or an S corporation or a C corporation. And if you have multiple owners. Now, if you have only one owner, you can actually, by default, the IRS looks at you and you are taxed as a sole proprietorship. So there are some different options, but you can also elect to be taxed differently if you're a sole owner. So I think there's a couple different elements. You can't just say strictly this is always the best way that it's going to work. One key factor, though, I think that has been isn't always considered is the setup for how your restaurant is financed. And when I say that, what I'm primarily talking about is do you have a money person and an operations person? Okay, so if you have that type of a scenario, sometimes it might be better to use a partnership type tax arrangement because they're more flexible in terms of the way you can distribute the profits and losses of the company. Okay. And as opposed to an S corporation, S corporation is very strict. You have to adhere to the ownership percentages of the S corporation when you're distributing the profits and the losses of the company. All right. There's no way you cannot veer away from that. So if it's a 50-50 ownership, the profits and losses have to be distributed 50-50 with an S corporation. Now with a partnership, though, if you bounce back to a partnership, you've got a 50-50 ownership, but say one person is the financing person, the money person, and one person is the operations person. Well, in some cases, that money person might say, well, I know we might lose money in the first year or two, so I'd like to take advantage of those losses because I'm in a very high tax bracket. I'd like to have those losses. You can't do that with an S corporation, but you can do that with a partnership. At least you potentially can. I mean, there's other rules you have to follow, but there's that potential there. So, you can't always just say, well, an S corporation is always going to be the best type of an entity from a tax standpoint. You really have to look at the circumstances on a case-by-case basis and make sure you understand. But another thing to think about is that can evolve over time. I've had many situations where there's a single owner of a company, whether it's a restaurant or a consulting company or something else, where we start off and we say, well, let's set up a single member LLC. You can be very simple, tax as a sole proprietorship. That means you don't have to file a company tax return. It's just a personal tax return with a little attachment to it, Schedule C, very easy. And then after the first couple of years, once you get your feet wet and you feel like, okay, this is a business that I'm going to be in for a while and I'm having some success, then we can convert and actually make a transition into either an S corporation, or if you want to take on new partners, new business partners, you could transition to a partnership, or even potentially, if you get big enough, maybe into a C corporation. So there's just various ways that can evolve over time, and it's one nice thing about an LLC. It gives you that flexibility to be able to do that over time.
Now, you're making really great points here that just points to getting the right advice, whether you're speaking to a lawyer or your CPA. And in some cases, it's sort of a collaboration between the two to put the client in the best position. Now, we're also sort of triggering this thought about taking money out of the company depending on how the company is set up. And that comes down to a term called basis. Can you explain that on, how you can take shareholder distributions or distributions out of a company based on available basis? Can you explain all the nuances of that? I know it's fairly complicated. I can't explain it, but I'm sure you can.
Well, I probably can't explain all of it in the time we have, but here's a basic overview.
Great.
Basis is a combination of essentially a couple things. First of all, it's the initial money that you use to capitalize the company. Okay, your initial investment. Mm-hmm. So think of it just like you're buying Google stock. You buy stock on the stock market. What you paid for that stock is the basis. So what you paid to set up your company, that's your initial basis. So you put $100,000 into your company, your basis is $100,000. All right. So that's where you start. Now, of course, your basis isn't going to stay at $100,000 because you're going to spend that money on, setting up the company. You're going to have operations. Hopefully you're going to have profits. And so the second element of basis is profits or losses. Mm-hmm. Say you start off with $100,000 very well, and you make $100,000 first year, you're assuming you have not actually taken any money out of the company as a distribution, right? So that's the third element, distributions. So once you then take a distribution from the company, that reduces your basis. Okay, so go back to the original investment of $100,000. You have a profit of $100,000, and let's say you only take $50,000 out as a profit distribution. Well, that leaves you with $150,000 of basis. And so the basis is important because it's involved, it's used in many different types of tax calculations, including whether or not you can deduct losses. So using the same example, if you have a $100,000 initial investment in your company, let's say the first year you lose $50,000, you have a loss instead of a profit of $50,000. Well, you can only deduct that loss on your tax return if you have basis, an initial basis. All right. So you do, in this case, in this example we're using, you put $100,000 in, you've lost 50. That's a deductible loss that you can take on your tax return because you have basis of $100,000 that you can net it against. So, the basis is very important to track. And then when you think about, you mentioned that you sold a business, at whatever time that you were preparing for the sale of that business, I'm sure you had your CPAs calculate your basis in the company, because that was used to determine your taxable amount on the sale of the business. So that's something that's very important to be tracked over time. And of course, we do that here with our client. We track the basis in our software, and it rolls forward from year to year. So it's a very important thing from several different elements, to tracking, what your investment is in the company, whether or not you're able to deduct the losses if you have losses for a particular year, and then how much tax you're going to pay when you actually end up selling that company at the end of the life cycle.
That was great, and I'm really glad that we got into that. Just one more really important detail to stay on top of for maximum benefit.
Absolutely.
Let's wrap up, Tony, by talking about the tax planning process. Now, let's just assume that a client has been in communication with you throughout the year. You've made some pretty relevant, critical decisions throughout. Now we're talking, it's November, and we're starting to think about, putting the books in order. What's really, really important at that time before they turn over their books to you? How can they make the process simple, and what can you do to really help them just at that critical time of year?
Well, number one thing is communication. I think that's very important to do, and I encourage my clients to reach out to me, and like you said, at the end of the year or even the middle of the year. And there's some clients I meet with quarterly. Some of them I typically meet 1 or 2 times a year. It just depends on the business and the nature of the business and what they're doing. But it's very important to communicate, and that can be as simple as a quick phone call to say, "Hey, everything is going well. We think things are very similar to last year, and it looks like our profitability is going to be good. Do we need to do anything special, or is there anything we can do now to try and reduce our taxes?" And we'll talk about that. We'll have a conversation. And but also it could be setting up a meeting and sitting down and going through the books and looking at things as simple as, well, have you reconciled your bank accounts? Have you recorded all your transactions? Are you in good shape to where we can actually close out the books in early January and go ahead and prepare that tax return and not have to be delayed doing that? All the way up to things like we talked about before. How are you recording your fixed assets? How are you doing is your payroll all recorded? Have you taken advantage of all the different expenses and deductions and things that you can? And is everything completely recorded? And is it going to be useful when it gets to be time to prepare your tax return? And then also thinking about planning for the future, just general planning, taxes and otherwise, just financial planning. How is your cash flow? Do you have enough cash to get through maybe a downtime if your restaurant is seasonal for some reason? Certain types might be seasonal, or like I think you mentioned, you were in a resort area that has a seasonality to it.
Yes.
So looking at different things like that, it's just a good time of year to talk and to think about things. Also, most tax advantaged moves typically need to be made before the end of your tax year. So if you're talking in January, there's a limited number of things you can do for the prior year. And in some cases, you can help out your situation by making some certain types of tax moves. But if you do that in November or December, there's a whole lot more that you can do before the end of the year to potentially reduce your tax burden and improve your situation overall. So it's just very important to communicate and just to be on a good wavelength with your professional and have an understanding going forward.
Well, I got a wealth of information from this podcast interview, Tony.
Good.
I can't thank you enough for appearing as a guest. I appreciate your expertise and your advice on all these relevant financial topics. If you're a restaurant owner, I hope you take a good, close listen, because chances are you've learned several things that'll put you in a better position. And it is, again, as Tony said, all about communication and establishing that close working relationship with your tax professional. So that was the Restaurant Rockstars podcast. If you appreciate what we're doing, please give us a review on iTunes. Thanks so much for tuning in, and we'll see you next time. Hey there, Rockstars. I'm hoping you gained a world of information from Tony. I worked super close with my CPA for well over 15 years, and it was peace of mind to know that a professional was on top of the tax code and every detail that affected my business. Not only that, my CPA was well versed in restaurants and understood my business. That's the difference between getting every financial advantage, not only at tax time, but all throughout the year. If you have any questions from today's podcast or are interested in talking to Tony, I've included his contact information in the show notes to this episode. Feel free to reach out to him at any time and he'll be happy to assist. I appreciate the great feedback we've been getting for the podcast. As a thank you, click my link in the show notes for a valuable gift from me. And be sure to tune in to next week's episode.
Thanks for listening to the Restaurant Rockstars podcast. For lots of great resources, head over to restaurantrockstars.com. And while you're there, download a copy of the book, Rock Your Restaurant. It's a game changer. See you next time.